The Russian ruble is facing new pressure as U.S. sanctions on Russian oil giants Rosneft and Lukoil take effect soon. These penalties strike at the heart of Russia's foreign currency earnings and could reshape the country's economic outlook. With Rosneft and Lukoil responsible for up to 35% of Russia's foreign currency sales, analysts warn the impact could ripple across the ruble, oil markets and the Kremlin's budget. The new U.S. sanctions block all transactions with Rosneft and Lukoil, the two biggest players in Russia's oil sector. Lukoil has been given a deadline: sell all international assets by December 13, and Washington is warning that any company buying Russian oil could also face penalties. Ahead of the sanctions taking effect, the ruble briefly strengthened, buoyed by reports of a U.S.-drafted plan that could end the war in Ukraine, potentially halting sanctions altogether. But many analysts agree once restrictions hit, pressure on the ruble is inevitable. Russia's currency market has already taken heavy blows over the past year. The U.S. sanctioned Moscow exchange in June, halting all trade in dollars and euros. Since then, the Chinese yuan has become the dominant foreign currency, with Western currencies traded only over the counter. In 2024, the ruble fell 37% against the dollar, but in early this year, it rebounded 45%, driven by interest rate hikes and hopes for peace talks pushed forward by U.S. President Donald Trump. Despite predictions that the ruble is overvalued, many economists see its fair level closer to 100 rubles per dollar. The currency has stayed unexpectedly stable in the second half of this year, thanks to Russia's slow rate cuts, central bank forex interventions, weak imports, and the push for import substitution. But now, with up to 35% of forex sales tied to Rosneft and Lukoil potentially disappearing, analysts expect a 10 to 20% decline in overall foreign currency sales in early December. The central bank, which accounts for around 10% of the market, has been selling yuan throughout the year. But traders expect those sales to shrink next year. What happens next may depend heavily on China and India, which buy 85% of Russia's oil. U.S. officials say refiners in both countries are cautious and risk-averse, aware that violating sanctions could expose them to American penalties. Their reaction will determine how much Russia's oil revenues fall. For Russia's budget, the hit could be sharp. Moscow taxes oil production, not exports, but falling export prices matter. In November, the ruble price of Russian oil used for tax calculations was 24% below budget estimates. Already, oil and gas revenues are down 21% year-on-year, and the 2025 budget predicts another 21% drop. A weaker ruble could help Moscow on paper by boosting ruble-denominated tax revenues. But with sanctions tightening, oil discounts widening, and buyers growing wary, the economic path ahead for Russia is becoming increasingly unpredictable.